Tom, thank you so much for joining us.
Sure. No, happy to be here, Tony. Thanks.
So today what we're going to do is we're going to discuss, like I said, the markets together. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to go over quite a few things. We'll start off with a quick introduction of myself and Tom. For those of you who don't know who he is, we're going to do a quick current market outlook because a lot has changed over the past week, a lot of volatility, a lot of changes. So we want to talk through a few of those things. And then what we want to discuss, I think the best way to learn a little bit more about TastyWorks and the platform is to go through some real trades, go through a few strategies. And during this whole time, we're going to be doing the TastyWorks demo. The TastyWorks has a whole team, including the guys on the desk that's going to be able to help you answer so many questions. So if you have any questions regarding the TastyWorks platform, any of the things that we're going to discuss, feel free to type them into the Q&A window. We will be answering those live. So please submit your questions. There will be someone there to answer those. And then what we'll do after we do a few trades together is we're going to go through some of the user submitted questions. And if we get through all of those, we're going to take some live questions here at the very end. So let's go ahead and get started. Before I do, I just want to give Tom just a minute to give a brief introduction of most of you know who he is, but I do want to give him a minute just to talk a little bit about his background. And specifically, Tom, one of the questions that we got during the session was, why you started TastyWorks. So if you don't mind, just talk a little bit about your background and a little background as far as why you started this company.
Okay. So in the 20-second version, which is about the shortest I can give, I started as a market maker on the floor of the SIBO. I was there for about 20 years. I built Thinkorswim, and then I built Tasty. We built Thinkorswim because we wanted to do something different, and it turned out technology was our best vehicle at the time. We wanted to be in the option business, but do something different than just being floor traders. And then we built Tasty because we realized after 10 years of building technology that we were missing a piece, and the piece was the content side. And so we decided to build a content machine, a digital network. And then obviously that morphed into another brokerage firm, which is TastyWorks. And that's kind of where we are today, Tony. So that's the very short my 40-year history in 19 and a half seconds.
Well, I actually learned how to trade options and futures through Thinkorswim, listening to your webinars back in 2006, 2007. So I wouldn't be here with it wasn't for you building Thinkorswim and doing those webinars. So I thank you, and I think a lot of our viewers here, thanks. We'll have a big shout out to you for doing that. So let's go ahead and get started because I do want to try to get through as much as possible and show everyone the TastyWorks platform. So let's start off just talking a little bit about where the current markets stand. We had the U.S. elections last week. Quite a bit of volatility, quite a bit of movement, off of that. The vaccine news on Monday morning drove markets substantially higher, which gave back most of it as of today's close. Right now, if we look at the Qs, which is the NASDAQ 100 index, we're pretty much right smack in the middle of this range that we've been talking around between 270 and 300 on the Qs. Momentums is fairly neutral. If we look at the broader indices, it's really small caps that is leading the way here. We've had a sell-off here in treasuries. And I think from my perspective, the big thing for options traders is really this substantial decline we've seen from the VIX, all the way up in the low 40s down to about 25 at today's close. So, my question for you is really, how have the events over this week, whether it's due to the election or the vaccine, how does that kind of change your views of the overall market, and what adjustments, have you made for your trading as a result of these two events? Well,
now that's a way longer than a 19-second answer, so I look at the markets as a pure, almost as a pure efficient market theorist, which means that I don't look at fundamental events for anything else other than opportunity. So I don't look at something like a stimulus bill or an election, or even the pandemic at this point, or the earnings that came out. I don't look at them as a fundamental underlying reason for buying or selling. I look at them all as events that lead to the creation of opportunity. through fear and uncertainty. So when I look at markets, I don't look at the election and go, wow, if Biden wins, we're going to go in the crapper, or if Biden wins, we're going to explode. Okay, I don't think that. I think if you told, we have probably 400 some odd people on right now listening to this chat. If you told every single one of those people, including you and me, who was going to win the election or anything else, like any bit of fundamental news, I don't think that if we told you that Biden was going to win the election, that you would have played, the upside or the downside with enough conviction to probably, make any money on it. I think though, if we said, hey, you know what? Everything's kind of priced into the election, so the best play on the board, maybe short volatility, that seems to me to make a lot more mathematical sense and a lot more like opportunistic sense. And so that's the way I think of the market. So anyway, over the past week, Tony, from last Tuesday night when the election took place till, basically we've now gone, five trading days. I think that you hit it pretty much spot on. The biggest mover out there, the most opportunity was, on the short vol side. I mean, I don't think anybody could have predicted the size of this up move. I think that was, kind of very unexpected, but after 2016 and after everything we've seen in 2020, I don't think anybody should be surprised. But again, when I look at the markets right here, I think to myself, hey, you know what's interesting? They killed the bonds, which is another reason why the small cap or the Russell, which is heavily weighted towards the financial stocks, why it's been so strong, in addition to kind of a pure sector rotation that we've seen the last couple of days, which is much greater than what anybody else thought as well. So I think that there's a couple of takeaways. And if you don't mind me rambling on for another second, one of the takeaways of the last 2 days was that if I told you yesterday that the market was going to be up 5 or 6% in the S&Ps, it would have been impossible to guess that the NASDAQ would have been down 2%. So that's another example of like, you don't really know, even if you know what's going to happen. So what you have to do is you have to just think about things in a much more quantitative sense, I believe, and just pick your spots. Stay small, pick your spots. And I think the trade opportunity, something we were talking about before the session started, yesterday was the busiest day in the world of options ever. So it's really interesting how people are gravitating towards strategic investing, which is what you do and which is what I do, as opposed to more directional trading.
Yeah, I completely agree. I mean, the markets have gone fairly out of whack for, as you said, when S&P is up 5%, NASDAQ's down 2%. There's also, I think, one of probably the only time in history where you saw energy or crude up 10% and airlines up 20% on the same day. And those are typically inversely correlated. So we have a lot of out of whack correlations that are currently in play that do, in my opinion, provide some opportunities. So let's take a look at some of those opportunities together. And I think the best way to do that is actually looking at the platform. So Tom, I think this is a good time for you to share your screen, bring up TastyWorks platform, and let's take a look at some of the ideas. I have a few here on screen, which we'll go over as many as we have some time for. These are just ideas, just to give you a sense for if you have an idea similar to this, whether you agree or completely disagree on a contrarian view, let's take a look at them together and see how we can utilize TastyWorks to look at the opportunities and analyze some trades. So the first one I wanted to take a look at here was Zoom. Zoom has made a huge move to the downside, whether you believe it from a fundamental perspective or not. Zoom has declined from well over $500 down to about looks like we're closing around 376 here today. Now, from my perspective, Zoom got a little too far too fast. Certainly went well ahead of fundamentals. This check back here down to the 376 level, from my perspective, speaks to the decline that we've seen from the vaccine. People concerned about the reopening trade, if you will, and selling off some of these high-flying tech names. And Zoom certainly was one that took a big hit here. And the reason I wanted to take a look at Zoom here is because I'm taking a much more contrarian view to the moves that we've seen over the past couple of days. I'm looking at opportunities and say which things has gone a little too far too fast. Have we exaggerated, the moves that we have seen off of the vaccine news? And for me, Zoom represents one of those, because the shift from working from home and schooling digitally, I think that's going to stay. I think there's going to be a much more permanent shift to that. And I think Zoom is a good representation of that. We had an explosion in implied volatility, and I'd like to look at perhaps selling some volatility, maybe some put credit spreads here. And that's why I wanted to take a look at Zoom. So why don't we take a look at that together?
Okay. Well, this is the option page in Zoom, and just because some people might like to see a picture of it, this is a picture of Zoom. If you wanted to see just if you just kind of want to see an option page, but I mean a chart. But I couldn't agree with you more. And let me go back to the trading page just so you can see this. I couldn't agree with you more about Zoom on so many different levels. But a little bit of consumer insight into Zoom. So if I told you the single worst performing stock for retail investors in 2020 was Zoom, would you believe me?
No.
The single worst performing stock, and we're talking about thousands of stocks for individual investors as far as P&L goes, is Zoom.
Wow.
Meaning
investors just getting it wrong.
Yes.
Timing it wrong. And
yes. The up move was so extreme. I'll go back to it just a quick second. The up move, this move from kind of the March lows are right about here where my cursor is. So this move from the March lows, which the stock was trading like around 100, let's say, all the way up to just over 600 when it came, just after that earnings explosion and everything else. And then now the move back down to 375. They caught traders in both directions. I mean, actually, this was the earnings move that was the freakiest of them all. This one right here, when the stock closed at about under, I think I want to say about 360, and then right around 300, and went to 500 the next day, and then came 40% move in one day, and then all the way back. Just some wild stuff. But when you think about Zoom, it has been the most difficult stock to trade. And so if you're out there listening and you've had a good year trading Zoom, well, you're one of the few. I'm in that camp. I'm in the camp that I've been beaten up by Zoom this year and beaten up many times. I'm not proud of it, but Zoom has been a tough stock. I agree with your assessment that the move of the last couple of days from 500 and change down to 370 today or 377 where it is right now after hours, that move's extraordinary and probably deserves some selling some put credit spreads. So do you want to take a look at those? Yeah.
So I think I would probably look at the Decembers as a starting point.
Sure.
I think are you filtering out the weeklies here?
I am filtering out the weeklies just to keep it on the most liquid options. Okay. This page is just the December. You can see here it's 38 days to go. And over here is the expected move, Tony, between now and December, which is $81.50. Now, the crazy thing about Zoom was in November, which still has 10 days to go to expiration, the expected move was $38, and the actual move today was $37. So we moved today 10 days worth of expected move in one day in Zoom. But if we go back to December, the expected move is just based on option prices is $81 between now and December expiration.
Got it. So let's take a look at selling credit spreads. Now, You and I have a slightly differing view as far as what are the optimal credit spreads. I like to get a little bit more aggressive. I like to sell closer to the 45 delta, closer to the at the monies, and buy back about a 25 delta. You like to sell about a 35 delta and buy back about the 20 delta. From my perspective, because Zoom is fairly volatile, I would err towards your types of credit spread. So let's take a look at something like yours, where we'd sell something like a 35, which I think corresponds with a 350 strike, and buy back a 25 delta, which is roughly the 320 strike. So 350, 320 credit spread. That's a $30 wide credit spread.
And you're collecting just over 1/3 the width of the strikes, which is kind of right in our math. That is your optimal sweet spot. That is your best risk reward. $10 is the perfect risk reward play. Because remember, when you sell credit spreads, put credit spreads, They are theoretically, the math is theoretically accurate with the probabilities. So it's the inverse of collecting 1/3 the width of the strikes. And it's the inverse of that. So your probability of success is about 67%. So in the case of this spread here, your probability of success is right around 65%.
Right. So I tend to find that when you're selling these 35-20 delta credit spreads that you prefer, that it's significantly harder from my perspective to find credit spreads where you're collecting more than 1/3. So here's an opportunity, a fairly rare opportunity. I think this speaks to two things. Number one, that just the extreme implied volatility that we currently see, and as well as the skew. Now, the two things that I want to point investors towards and having a better understanding is to how to quantify the elevated implied volatility. And also another thing that both you and I take very seriously with our trading is liquidity. So if you don't mind just walking through investors kind of how TastyWorks helps investors understand where volatility currently sits and how to measure liquidity.
Okay, well, there's a couple of ways. Obviously, you can measure liquidity. The simplest way to measure liquidity is when you look at the underlying stock, you can go right to volume and you can see the 20 million shares traded of a $380 stock. That is what we call ultra liquid. Now you are going to have, that's going to be 4-star liquidity no matter what. The other nice thing about the stock is it has a 68 rank on the IVR. Now the one thing, Tony, you got to mention here is that earnings are November 30th. And Zoom is one of those stocks that's had some historic, especially their last earnings, historic moves. It's unlikely to see those back to back, but we just have to throw it out there so that people understand. So if you do this put credit spread, and today is, let's just see what day it is today. It's
November 10th.
November 10th. So you've got at least 2.5 weeks, where if you don't want to play earnings with this play, right?
Yeah, correct.
Okay. So you got plenty of time. This is a directional play that you probably won't hold for 20 days. So it's fine in that sense. 38 days to go to expiration, 91% in implied volatility, 68 IV rank, tons of liquidity. And then let's take a look at just the volume over here. And you can see hundreds of contracts traded at each strike. And these are big, relatively liquid underlyings. Now I trade Zoom all the time. I probably made 20 trades in Zoom today, maybe 20 trades in Zoom all day. I would say that the average spread in there trades 3 to 4 cents around the mid price. Worst case is 6 or 7. Best case is 3 to 4.
This is something that we actually talk about heavily is liquidity and measuring liquidity, because a lot of investors still, I find, use the open interest and volume of the strikes that they are buying or selling to look at liquidity. And that's something that we talk about a lot. And, and I'm glad that you bring this up, that you don't look at volume or open interest of the individual strike. You're looking at the volume and open interest of the entire chain, which gives you some indication. But really, it's more of the liquidity of the underlying stock, because as a market maker, when you are making a market, you're concerned about how liquid is the underlying stock in order to hedge the trade that you're looking to make. And at the end of the day, for most retail investors, you're not going to utilize all of the liquidity that's available out there, even in a smaller cap name. But generally speaking, when we're looking at this, we're looking at the bid-ask spreads. And the one thing that I've been talking about is, if you think of the bid and the ask price, it's kind of like the sticker on the car when you walk onto the car dealership. That's the worst possible price that you could possibly pay. And the benefit of a two-way market, having a bid and an ask price, is that it gives you a sense for what the market maker believes is the theoretical value of that option, or what the fair value of an option is, or what we refer to as the midpoint. And the midpoint gives you a sense for where you should start your negotiation and how you should move off of that. And as you say, most of these trades, or many of these, especially when we're talking about something with a 4-star liquidity, if you don't mind bringing that up on TastyWorks, just to show investors how they can see the liquidity. But with anything
under quote detail, it will show in here. So it's right under quote detail. It'll show our liquidity meter.
Yeah, so when you look at liquidity, something with a high amount of liquidity, generally speaking, you're going to be able to get filled within 3, 4, 5 cents of the midpoint. Even if the spreads are 15 cents wide or 20 cents wide, you can get filled within a few pennies of the midpoint, is what we have historically found. So Perfect. So let's move on to the next trade. I want to take a look at a few trades.
Let me say one thing about this, because your comment was really good, but people need to understand this. There's a lot of people on today. And Tony, back when I was a market maker, nobody cares about open interest per strike anymore. That's all that matters, because you're just trading with a server. And the thing you should also know is when you do a spread, like this spread that Tony just pointed out, this 350, 320 spread, the reason that this spread is going to fill at or near the mid price, about 3 or 4 or 5, 6 cents away, something like that. The reason for that is because the delta between these two options is only 10. So if you did the equivalent, let's just say, of 5 spreads, the counterparty to hedge it only has to do 50 shares of stock. So the spread is only going to be as wide as that 50 shares of stock is. That's how the whole system works. It's so simple, but when you know how it works, it makes so much more sense. If you do an individual option and you do 5 individual options, then the counterparty has to hedge 160 shares. So they make a wider market. But if you do a spread, they only have to hedge 50 shares. So they give you a much narrower market. That's how it works.
Well, it's a good insight into how the sausage is made.
There you go.
Great. So let's move on to another idea. I want to take a look at XLV. We've seen this. The reason I wanted to look at SLV is purely just more on a technical perspective, and I think a lot of investors that are currently on this call, have a technical view on things. We've seen, XLV was the strongest sector out of the gate off of the March lows, and then pretty much since mid-April, it has underperformed the broader markets, but have come back to life a little bit off of the election outcome. We're seeing this breakout here above 110. We're seeing a rotation into healthcare, and I'm looking for a potential continuation here, higher here. And XLV, as you can see, has a much lower IV rank compared to Zoom. I think Zoom was at 67. XLV here is at 22. And we've seen volatility pull back quite a bit here in the broader markets. This is, from my perspective, if you think of the post-pandemic as a different volatility regime as before the pandemic, we're near the post-pandemic lows, if you will, of where volatility actually is. So from my perspective, looking at XLV, I actually really like, or I'm looking at some opportunities where I might be interested in buying some volatility here. XLV not as low as maybe some of the individual names, but this is one of the areas in the market where I'm starting to look at buying some volatility here. So XLV, I'm looking for that breakout here above 110. I'd like to explore either buying a call option, either a simple call option or maybe a call spread.
Okay, you tell me, and I'll load up the platform.
So generally speaking, when I'm buying an option, I usually like to go a little further out in time. I usually go out probably closer to 60 days to expiration. So I think the Januaries here are probably suitable. And
okay.
XLV it's a little weird here from the perspective of there's no strikes between 110 and 114 spot 33, which is a fair distance, if you will, from one strike to the next. So the only strikes that we really have here is the 114s. From my perspective, I do think the Marches are a little too far out in time. So here is an opportunity where I would probably buy the first out of the money strike price, because the 110s are already in the money by $1.27 or so here. So let's take a look at either the 110 or 114 spot 33 calls to buy.
Okay. There you go. They're 235, 250 was the market. The market in XLV, the options are a little bit wide for an ETF, but the stock has been a little bit crazy. I think the most important thing, and we don't buy a lot of out of the money naked options, but that's obviously that's your prerogative. But the one thing I think you have to know when you're looking at a stock like XLV and you're looking at making a decision with respect to buying a call or buying a put, whatever it is you need to take a look at the expected move based on where prices are right now. Because you remember, all implied volatility is, when you said implied volatility rank is 22 and it is low, you're right. And so what that means is that this number over here, this 22, is in the 20 is ranked 22nd out of 0 to 100. So what happens is the expected move is pretty accurate here, which is $7. So if the stock's trading for 111, that means there's a 68% chance it could touch that up at 118. That's all that means. And so if the stock is 111 and 118 is the target, you're paying $250 for this. It all is based on timing, Tony. So it just depends on, you have 7 points of upside that the marketplace is predicting, or downside, but you have 7 points of upside if you're bullish. And what you're hoping for then in this case is, when that happens. And the sooner that it happens, the better off you are. And since you're paying $2.50 for these 114s, you're probably looking at a price target of, you can tell me what you think, but I'd probably be looking at a price target of around $4 if I was buying those calls.
Right. So, and this is where I think perhaps it might make a little bit more sense to look at a debit spread instead. Maybe looking at those 110 calls instead of the 114 calls and selling the 119s against that. Perhaps that might be a slightly better strategy here. I would sell maybe the 119s.
Yeah, you could sell the 119s. The 110, 114, 33 is 230, which is 50% of the width of the strikes. If you do the 119s, it's 380. And again, these markets are wide. I don't know why they're so wide right now. It's just the way they may have just closed them there or whatever. But that's really, both of those spreads fit our criteria for debit spreads. I think that for me personally, I'd rather do the 110, 114 for $2.30, just because you're getting a lot of protection from those 114, 33s. Like they're taking a lot of the premium risk out of the equation.
Yeah, I completely hear you. So it was 230 versus 360 for the 119th?
380.
380, got it. So you are taking a substantial amount of risk for that 119 versus the 114. So, that's how you can quickly look at some of these types of trades and decide which one's best suited for you. I think this is a great way to understand a little bit more about the platform.
I'll give you another cheat sheet thing, just because most people don't think of it this way, but this is a little bit of a cheat sheet. Mm-hmm. If you're looking at an underlying like XLV, which I have no position in at all, I told Tony before we did the show today, I said the only position of all the stocks you want to talk about, the only underlying I have no position in is XLV. But when you look at a stock like this and you decide, okay, I want to buy, let's just say, just as an example, the 114.33 calls because you're bullish and you expect an up move. One of the ways that I said the target price is around $4, but one of the cheat sheet ways that you can always look to see kind of what your target price is you go to the strike that's one below the one you're buying and you see where that's trading for the bid. It's 420. And that becomes kind of a old kind of market maker trick of what your target is based on expected move. So $7 expected move, you're buying a $2, let's say, and $2.45 call, and your target price, if you just need one in your head so you have some context, is always the strike one below, which is, in this case, the 110s or 420 in that range.
That's an interesting, I've never heard that before. That's a very interesting way to think about that.
Well, it's just because option pricing is symmetrical, right? Everything's symmetrical. There's put call parity and everything else is symmetrical up and down the scale. So this $7 price move, okay, there's a symmetrical tree that's in all these pricing. So when you think about what is a realistic, expectation, it's to move up a strike. That's it. Right. These are weird strikes, by the way. But yeah, the expectation is to move up a strike.
Very weird strikes. Okay, let's take a look at bearish opportunity. Do you have positions in both XLE and Jets? Do you have one that you prefer to look at?
I have no position right now in Jets, but I've had positions on in there all on and off all year. And XLE, I should have positions on in there. Yeah, I have a couple of positions on in there.
So from my perspective, I think the roughly 14% move we saw yesterday and today up another 1%. From my perspective, I think this was a little similar to Zoom, perhaps a little too far, too fast. does the vaccine, 90% of efficacy on Pfizer's vaccine change the outlook or demand for oil in the short run? From my perspective, no, certainly doesn't change the financial picture of any of these oil producers where the cost of getting oil out of the ground is still substantially higher than where oil is currently trading. So I would prefer to fade these types of moves. Looking at IV rank here at 26, not particularly high here. I'm curious as to how first of all, do you agree with that general view? And if you do, how do you think you would play this?
So I do agree with your general view. I think it's overdone based on the last 2 days. I have on in there a very small position right now because it's an inexpensive stock with low IV, like you said. But I have on a 31.37 strangle. With a little bit of bearish delta. I'll show you right here. So I have the December 31 puts I'm short and 37 calls. So I'm short a 28 delta call and a 21 delta put, equal quantity, 20 of each. So that gives me short 7 deltas for each spread times 20 is 140 deltas. So I have a very small, I'm short the theoretical equivalent of 140 shares in a strangle because I want to take advantage of premium decay. So that's exactly how I'm playing it. Rather than just tell you how I'm playing it, I'm just showing you. That is the position I have on right now. Short 20 of these, short 20 of these. It's negative 140 deltas, and that's my whole position.
So let me ask you this. With IV rank, and maybe you established this when IV rank was higher, what is the general criteria you typically look for from an IV rank perspective to enter a short strangle like this?
It's a little bit unclear in 2020 because of what happened in March and the pandemic in the sell-off in late February and early March and oil going to obviously to negative numbers on the May expiration really threw off the IV ranks for oil. Let me just show you something really quick. I know you don't cover a lot of commodities, but I think it's important to look at crude oil up here. Mm-hmm. If you see the IV rank of crude oil, because it did trade negative, it's only 7.3. But that is a very misleading IV rank because it's crude oil's had a huge move. This crude oil chart looks very much like the XLE chart that you just showed. But unfortunately, because crude oil is never going to be able to get a decent IV rank until next March because of how crazy it got. And so sometimes that can throw off the skew, ever so slightly. I will say that for most opening trades, you'd like to have an IV rank right now 25 or higher. 20 or lower, I more look like, to close positions, and under 10, definitely closing. But oil is one of the few that's a little messed up, and I don't think crude oil is really rich enough to trade. So we've been putting positions on in all of the surrogates. So XLE, I have positions on an XLE, XOP, ExxonMobil, USO, because I think they're all decent trades. And I think they're all decent commodity trades. I just have nothing on in crude oil itself, CL.
Got it. So
my thought process is, yeah, you should be in these positions. And I'm short them all, just like you said.
Got it. Now, the one thing about XLE being a relatively low price stock, would you lean more? So could you go back to the deltas that you chose again?
So in this case, and the reason I think this is appropriate is because this position was actually just established today. So I had other positions on in there, but this position was basically put on the opening this morning. So the deltas I chose were just based on having a few short delta suspicions because I'm a little bit bearish in crude like you are.
Got it. So
I chose the 28 delta call and the 21 delta put. And the reason I did that, Tony, is because based on all our research, the sweet spot for naked options is somewhere between the 18 and 23 delta. But when you're dealing with a low price stock like XLE, the 20-23 delta is just too cheap.
Right. That's what I was actually going to ask you was, with such a low price stock, do you adjust your strangles to a higher delta?
A little tiny bit, 1 or 2 strikes. Yes. The answer is yes. What you do is you see this credit here of $1.31. And I don't remember where I actually put the trade on this morning, but I think it was, I want to say it was $1.38 or something like that. But the answer is we will adjust if this credit's like close to $1, it's not enough for me in this market. I think $1.30-ish is about the lowest I'm going to do anything for.
Got it. Do you usually think of it as a percentage of the stock price when you're selling a strangle or straddle?
I do not. I think of it, I do think of the credit in general as it has a relationship to the underlying price. Like, for example, if I was trading Zoom, going back to Zoom, what we did before, I'm short strangles in Zoom and they're $40. Like, I would never sell a Zoom strangle for $1.31. I would be looking at kind of the 16 delta in there, and they'd probably be about, $16 to $20, and it'd be a $40 strangle. So it really depends on, the underlying price. But there's not many $30 stocks. Like Lyft had earnings this afternoon. We did something in there. Uber was a $30 stock 2 days ago. DraftKings, I have positions on. It's a $35 stock. So there are some stocks in the $30 to $40 handle that we will trade with, short premium. But generally speaking, a stock like XLE, you're not going to have, that kind of volatility to generate that much premium.
And I think this is an interesting example here with XLE. They're making such an extreme move, and after that extreme move, selling that strangle, right? Because, and I would imagine that you many times would do the same thing or similar type strategy with a iron condor, right? After an extreme move, when volatility is high, you sell a strangle or an iron condor. This actually, from my perspective, for a lot of investors that, look at these types of strategies, I tend to find that they do the exact opposite. They wait till things are really quiet. They wait for a stock to trade within a range. They kind of say, hey, this stock has been in this range for a while. It's in the middle of this range. I think it's a good opportunity to sell an iron condor. I'm curious as to your thoughts on that, because I've always thought the exact opposite. I always thought that when a stock is trading near, in that range, you've identified that clear range, it's in the middle of that range. That's, in my opinion, the worst time to look at selling that straddle or that iron condor. It's actually after a big move, when perhaps exceeded outside of range, when you actually want to sell that strangle. And I'm curious as to kind of you doing this a lot, what your thoughts are.
So I have some very strong opinions on this. And the first thing is, I completely agree with you. In my style of trading, just to give you an example, Biogen opened down 100 yesterday. And the first thing I did was put a strangle on in Biogen, down 100. I had no position coming in yesterday to Biogen. And I put on a strangle. It hasn't made any money. It hasn't lost any money. But I agree with you. And when stocks have big moves like Zoom, you talked about selling a put spread today. I would have had no issue selling that put spread. I also would have no issue doing a close to the at-the-money put spread. But since you have to put up no additional capital, selling a further out-of-the-money call spread just to collect the extra credit, because it costs you nothing extra to do. So that we call that like a skewed iron condor. We call this one a skewed strangle. But to answer your question mathematically, which is really interesting, so we've done an incredible amount of research through our think tank on exactly that question. And the answer is that implied volatility, although you think that it immediately reverses and causes a change in direction, tends to have somewhat of a clustering effect at high levels and low levels. So when you have these huge moves, there is a higher probability of another huge move. I'm not saying what direction, but when you have a huge move in any direction, there is a higher probability. That means a move into the 2, 3, or 4 standard deviation area. There is a higher probability of another move shortly thereafter than there is. And when you have, as opposed to when you have really low implied volatility, like when volatility is just dead, there is a statistically higher chance that volatility stays dead for a longer period of time. It clusters at very low levels. It clusters at very high levels. And so that's just an interesting piece of research, but I tend to trade exactly like you do.
I'm glad that you were able to share that piece of research, because that is something that I feel, but I have never been able to quantify.
We've quantified it. It's really interesting. I will send you a link to that piece of research. It's fascinating.
Great. I'm looking forward to that, and I'll share that with everyone once you share that. So let's just take a look at one more trade, and then let's jump over to questions, because we have a lot of questions here. From my perspective, the rotation into small caps is another theme that we've been talking about for quite some time. We've been talking about the rotation to value for years, and we seem to have finally cracked this a little bit. And then see whether it's the election outcome or the vaccine news, we've seen a bit of a movement here on IWM. For me, the breakout here, I don't want to chase it. I don't particularly like chasing this particular move. I'm actually waiting for a bit of a pullback here and establishing more of a long position. I was actually looking at selling some puts here on IWM. Curious as to whether or not you currently have a position and what your thoughts are here.
I am currently neutral in IWM. I have a short strangle in there. I've been trading it all year from the long side, and it has not. I've been trading it against the NASDAQ all year from the long side. We just started to get paid the last, few days. It's been a tough trade for this entire year because if you remember, for most of the year, the NASDAQ's been way stronger than everything else. Just the last couple of days, the NASDAQ got weaker. There's a couple of reasons for that if you're looking for a fundamental reason. One is obviously if there's an end to the pandemic in sight, that really helps small caps. And two, if there's an end to the pandemic in sight, it will send interest rates higher, which help all the financials in the small cap sector. And three, it will hurt, some of the NASDAQ stocks. And you're seeing that sector rotation take place right now. But I still feel like when you look at all the indexes, the Russell has the highest implied volatility rank and the highest implied volatility itself. So I think it's one of the more interesting strangle candidates. It's had a parabolic move the last couple of days. It's been hard to defend.
Okay, so I actually think that's a really good segue to the questions because we actually had some questions along these lines, and I know you have a limited amount of time, but let's take a look at some of the questions. I'm going to actually jump into some of the questions that are more related to what we were talking about here. There was one question here by Jason, and if you don't mind, the question by Jason is, what can you do to defend your short put as they move against you? I think a lot of investors, have had short put positions over the past couple of months that have started to move against them, whether you entered them in late August or, throughout the choppiness that we've seen over the past couple of weeks. What do you do on a short put that has started to go against you?
Jason, welcome to my life. This is what I do. And short options that go against me is the story of my life. The good thing is I've spent the better part of the last 9.5 years just researching this one specific topic. And I will give you the set of mechanics that we use. If you have a short put position on, the best way to defend it is to sell a short call against it. And I'll tell you why that's the best way. The reason that's the best way is because you put up no additional capital to sell the call. And if you're short a put, let's just say you're short a 25 delta put, and that means you're short an out of the money put, and all of a sudden the stock starts to go down. And now your 25 delta put becomes a 50 delta put. The way to then start, because you get nervous now, the way to protect your position is to sell a call of 25 or 30 deltas, one half of the put delta, to reduce your risk in half. And then if the stock continues to go down, you continually roll down the untested side or the call side, and you chase that put all the way down. Now, you can get whipsawed and you can get, we call it double whammied or whipsawed or whatever else if the stock pops back up. But that's the most capital efficient way to protect that short put. Another way to protect the short put, if you're less concerned, it's still out of the money, is to roll it out to the next expiration cycle. So you buy back the front month put that you have and you sell out the next monthly cycle. That will reduce your risk by 30%. So if you sell an opposing option against your short put, you reduce your risk by 50%. If you roll it out to the next month, you reduce your risk by 30%. Those are one choice 1A and choice 1 and choice 1A. The other way to protect yourself in the future is just keep your size small. You never know what's going to happen. And as bullish as you are, or as bearish as you are, as whatever you do, if you keep your size small, you can always defend your position.
I think that's really good advice. Especially with rolling your short puts, that is the simple strategy here to use. But as Tom said, selling those calls against it is certainly one way to go about doing so. So Rahim is asking a question. When selling covered calls, is there a delta value and time frame that you typically use? He's heard that you've mentioned the 45-day time frame before, and he would like to ask you to elaborate as to why you use that time frame.
The 45-day time frame, Rahim, has the best decay curve available. We call it an optimal decay curve. That means 45 days is the best risk reward based on all the research we've done. You have the least amount of gamma risk and the highest amount of premium to collect. That's why we choose 45 days. Now, if you're looking for the delta, again, delta is a preference thing. And I'm not sure what Tony would say here, but I think we're going to be pretty close. We choose the 35 delta option, Tony, as a default.
So I guess it depends on what's your primary goal here as far as an option from a cover call. Whether your main objective is to collect as much premium as possible, or for many investors the objective is more so to make sure that they don't lose the stock. So I will say that based on that, from our research, you want to lean towards more the 10 deltas if your goal is to make sure that you maintain the stock and you're just generating a consistent income stream. If your goal is to generate as much income as possible, I tend to agree that the 30 to 35 delta is the optimal strike price.
Yeah, I'm a basis freak. And so for me, because you don't know what's going to happen, a covered call is a long bias position. If you're holding a stock for 100 years, you're a passive investor. Sure, you can go to the 10, 15 delta. I mean, anything less than 16, which is a one standard deviation, to give yourself that 85% chance of success no matter what. Sure, you go to the under 16 delta. But if you're looking for the highest risk reward, dollar at risk type thing, that's why we like the 35 delta. It's just, like I said, it's a matter of preference.
Yeah. I think this is a really good segue to the next question, which, we get a lot of questions like this, and I really want to spend a little bit of time on this, which is a segue to the last question. And the first question, and there's two questions that I think are in very similar veins, so I'm going to read both before we answer. The first question is from Russell. He's asking, comparing selling weekly versus monthly cover calls, it seems like the premium is much better for weekly sales, but many investors like investors like you and I advocate for that 45-day option. And Russell asks, assuming the trader is willing to deal with the hassle of weekly sales, wouldn't it be more profitable to sell weekly options versus monthly options? Now, I think, Tom, you understand where this is going. And I just want to reiterate a second version of this question, which is, I think, for those of you that are selling more credit spreads, or actually, you know what? Let's answer that question first, and then we'll go to the second question.
Yeah, and just a quick reminder, everybody, just because I was just reminded, Scott, Chris, and Ryan, 3 people from our trade desk, and Scott's actually the CEO of TastyWorks. They're on the chat, and I know there's like 500 people on, and if you want to ask them anything, nothing is off limits. And Scott also ran Thinkorswim, so he's very clear of the concept, and you can fire off any questions you want at them, anything, and just ask away so that Tony and I can help you. So let me just think about this for a second. So why don't you just ask the other one? I'll put them both together because it'll make it simple.
Okay, so the other one is more so this was referring to whether you're selling weekly versus monthly options. Yeah. The second one is a variation to this or an extension to this. So I summed up his question. His question was much longer, but I'm summing it up, right? And the question, the strategy that Al is selling, he's selling 2 days to expiration. He's selling credit spreads on SPX, and he sells 2 days from expiration. He sells the 10 delta put, and he sells a 100-point wide credit spread where he sells the 10 delta put. And his average risk to reward here is he's collecting about $3 and risking about 97. So really far out of the money, high probability, very close to expiration, SPY put. And he's saying that this back-tested even through multiple crashes has seemed to be viable. And he's asking, isn't this viable?
Okay, I'm going to answer those separately now because they are two different questions. Yeah. So the first question with the covered calls using weeklies versus monthlies, you're going to be very surprised at the answer here. But when you do weeklies, let's say there's 4, let's just use a simple month with 4 weekly cycles in it, right? You actually pick up an extra week's worth of premium. So if you do a monthly cycle, so if you do 45 days, you actually pick up 10 extra days worth of premium. So if you're going to roll every single week on a weekly cycle using 45 days out, and you're going to use weeklies instead of the monthlies, instead of 45 days worth of premium, you will get 55 days worth of premium. That's how it works. If you do 27 days out, you'll get 35 days worth of premium. So you get that extra, you basically get an extra week for each month. Now, what's interesting about that is you would think that that extra week for each month is going to have some kind of enormous return over the monthlies. And the answer is, after doing 20 years of research, researching 20 years using the SPY as the underlying, if you did this, because the reason the SPY is a little bit more conservative than using some of these, individual equities, but the results come out exactly the same. So you would think that because you picked up all those extra over the course of a year, you're going to pick up, essentially 12 extra weeks of premium, right? That's how the math works. But in the end, because of the heightened risk and because of some of the down moves that you miss when things go lower, obviously, and you can't protect yourself as much, if you hold those to expiration, you have much fewer management options in the course of that 1 week, and you actually don't make any more money. So the answer to the question is, it is not advantageous. It's a coin toss, and it's easier to manage using the 45-day options. That's number one. On the second question, the guy, Al, I think it was, who's using the 2-day to go to expiration, and he's selling an out of the money put and then $100 wide call spread. Is that it?
Put spread. So it's a really far out of the money put credit spread on SPX. That's 2 days to expiration, where he's selling the 10 delta and then buying back $100 lower. $100
lower, whatever he can buy for as cheap as he can buy it. Got it. So this is interesting. This is also something that we've studied. And the answer here is, it depends. So your long-term results depend, and I don't care how much you think you've backtested this, because we backtested this a lot. And your long-term results depend on when you started this. So if you started this in 2000 and late 2009, 2010, you hit it out of the ballpark. You hit a home run. You only had, I think, 6 or 7 bad situations in 12 years. If you started this in the beginning of 2020, you're dead. If you started this because you'll never trade again. If you started this in 2015, you're down money. If you started this in 2005, you're up money. If you started it in 2000, if you started in 2000, you're up money. If you started in 2005, you're down money. So it all depends on what your start date is. I know that's almost like cherry picking, but essentially, there was a 10-year period from 2010, let's call it, to 2020, when it was a beautiful trade. There was a 10-year period from 2000 to just about 2008, 2009, where it worked for 8 or 9 years. But you know what, Tony, if you started in 2007, you would have quit trading. If you started in 2019, you would have quit trading. So it's hard to say, it has very mixed results depending on your timing.
Yeah, I would say that this strategy has come back to life multiple times, over the past 15 years or so, as you said. And it really just all depends on when you start. And I will say, a lot of investors started this strategy, after the coronavirus crash, right? So, over the past 7 months or so, this strategy has worked, right? Totally. Perhaps the beginning of September was a little dicey for you. Maybe you lost some money on that. And you probably did lose some money on that in the beginning of September, and you might have wiped out all of the gains that you made from the previous 4 or 5 months. So the strategy is...
Let's not discount the fact too, that ever since the pandemic, you've been dealing with heightened volatility at 2 times normal levels. So if you go back to 2019 and 2017, you're talking about premium levels that are 1/2 of what he's receiving today, literally right. 1/2. So yeah, it's worked since the end of the pandemic for sure. Since the end of the meltdown of the pandemic.
Yeah. And, it's just the strategy that we call picking up pennies in front of a freight train. You are literally doing that. That's what the risk to reward of risking $97 for every $3 in potential reward. So
listen, we all do it. Just so Al knows, we've all done it. We all do it. We don't do it that often, but we've been there, done that. And, it's part of the maturation process of learning to be a trader.
Absolutely. And I think this next strategy actually, or the next question, rolls very well into this, right? So far we've talked a lot about entries, cover calls, whether to do weekly or monthly cover calls or credit spreads. The next was related to exits. So Steve is asking, why is the optimal exit point 21 days from expiration for credit spreads when there's more time decay to benefit from if you wait until 14, 10, or even less? Seems like we're missing out on greater returns.
He could be right. So, Steve, you could be right. I will tell you, I don't know if you are a gambler, and if you're a gambler and you like to go to the casinos, the question I would ask you is if you hit on 12 versus the dealer having a 10, or versus, whatever. Let me just take that back. If you hit on, not the versus dealer having 10, if you just hit on 12 no matter what. And the reason I ask that is because there is a tiny little statistical edge if you hit on 12. And when I look at this, there is a very small edge to take your credit spreads off at 21 days. It's less than 1%. So to answer Steve's question, if you're looking straight at the math, he's right. There's no difference if you take it off at 21 days or if you wait till 14 days or 7 days. He's absolutely right. However, there's another side to this equation. Like I said, the edge in favor of taking off is less than 1%. But the reason that we do it, Steve, is because it fits in with our trade mechanics. So what you end up doing by rolling or by closing or rolling or doing whatever it is you're going to do with vertical spreads is you keep all your mechanics in line so that you don't have to focus on that credit spread necessarily, and you can just manage all your positions at the same time and then keep everything mechanically in place. That's the reason we do it. It's mechanics. It has nothing to do with statistics.
Yeah, so that's one aspect of trading options that I think is very important because there are all these different strategies. They all have optimal kind of entries and exits, and sometimes when you're managing multiple positions, it's difficult to remember at what point do I want to exit a trade. And when you have a mechanical rule like that, 21 days from expiration, it's a no. You don't have to think about it. It's something that you can just set a rule and stick to it. The best traders are the ones that are disciplined. The best traders are the ones that are focused on risk management rather than how much money can I potentially make. And it's really that discipline that you have to build into your trading system or trading rules that allow you to stay on track.
Yeah, I mean, there's so much that goes into how much you make on a vertical, that in addition to just holding it for an extra week, what does the stock do? What does volatility do? All that kind of stuff that I think the mechanics to us are more valuable than the few extra days. Let's put it that way.
Yeah. The next question I thought was a great question. And as John asked, and he was asking about selling credit spreads, right? And he was saying that, just typically the optimal credit spread has roughly about a 60% probability of profit. Now, we are referring to probability of profit. And he's asking, how do you make progress with this strategy? Because he's assuming that in the optimal credit spread, you are risking about 2 to 1. So for every dollar in income you collect, you're risking about $2. If you take profits at 50% and you have a 60% probability of profit, he's done the math where, if you do that 6 times, you're collecting $500 each time. And the 40% of the time you lose, you're losing the other 2,000. Doesn't that come out to be even? And you basically make no progress if you do this trade 100 times. So I thought that was actually a really good question. I really wanted to walk him through the math as to why you can still come out ahead selling credit spreads that are what we call optimal with the 2 to 1 risk to reward ratio.
And the answer is he is pretty correct. I'm not going to say 100%, but you are. I forgot who that was. What was his name?
His name was John.
John. So John, you're pretty close to being spot on. And we're not going to argue that you have some kind of huge mathematical edge because credit spreads are theoretically, they're perfectly in line from a theoretical value thing, and the probabilities are spot on. The difference is that you get to pick and choose when you do your credit spread. So, for example, like you don't have to do a credit spread in Zoom today. Like Tony doesn't have to do a put credit spread in Zoom, but the stock's down $37, so he gets to choose his entry point. That's important. Second thing is you get to choose an underlying that has extremely high implied volatility, so the options are super rich. And in a stock like Zoom, you have a lot of put skew, or any stock like for that matter, where you want to do a credit spread. The reason you want to do it is A, you feel the stock is at an extreme. B, you have IV rank in your favor. You have skew in your favor. You have the time duration in your favor. You have the strike selection in your favor. And then even though the math will play out to be statistically accurate, you can choose when you want to get out of that underlying. It's not like a football bet or something else where you can't get out or you have to pay to get out. This is a liquid marketplace where you can get out when it's strategically advantageous for you too. So what happens is when you factor all those things in, the ability to manage the trades early, the ability to adjust the trade, the ability to do something else against it, and to actively manage that trade, what happens to it statistically is your P&L per day, and this is the most interesting thing that most people don't realize, but your P&L per day is not a straight line from the day you put it on to the day you take it off if everything else was equal. Your P&L per day on the first 24 days that you hold that, from 45 days to 21 days, is significantly higher than your P&L in the last 21 days. Because when you factor in the risk and the movement in those last 21 days and the higher delta, your P&L is actually greater in the first 24 days. So you get to take advantage of that, which skews the return slightly into your favor. So instead of being 50-50, it's more like a 55-45.
Yeah, and the one thing I want to also keep in mind is that when you look at probability of profit, that's assuming you hold it to expiration. We're not holding this to expiration.
That's right. That's right. And that's why it's not exactly a zero-sum game. Exactly.
And this is really where however you choose to pick your trades, whether it's technical or fundamental, this is really where that comes into play, and you're putting another directional edge in your favor depending on how you go about deriving your directional outlook.
These are great questions, by the way. These are awesome.
Yeah, I picked these and I thought these were fantastic questions that everyone could really learn a lot from. A couple of questions regarding kind of the platform itself. Number one, can you trade pre-market on TastyWorks, and can you short stocks on TastyWorks?
Yes, you can short anything you want: stocks, options, futures, even in an IRA account. Not stocks in an IRA account, but you can short options in an IRA account. You can short futures. You can short options on futures. We are the least restrictive of any major online broker in the world. So from a risk perspective, we don't view client risk the same as anybody else does. And we are the most liberal when it comes to how we treat client risk. And the answer is, of course, you can short stocks. You can short anything you want. We're indifferent to product. We're indifferent to long or short.
Great. So Shankar is asking, how do I know if an ETF or index, and I think this is referring to more indices, is cash settled or not? Is there any flag or indicator to anything that's cash settled?
There are no cash settled indexes other than the flag would probably be that they end in an X. So like SPX, DJX, but RUT is cash settled. So it doesn't always work that way. But when you talk about cash settled, there's not that many cash settled products, but SPX would be the biggest. VIX would be the second biggest. Third one would probably be NDX, which is the NASDAQ. But usually they end in an X except for RUT. And that would be kind of my general rule of thumb. There are not that many cash settled indexes.
Yeah, those are the only ones that I can think of that traders, or at least that traders really trade, to be perfectly honest. I think you've already rattled them off. We talked a little bit about this before, but we didn't really get into the specifics. And Ralph and Dennis had a very similar question. He was saying, since strangles are one of your favorite option strategies, can you please take a deep dive into, what your preference are in terms of the rules to enter and exit? So both Ralph and Dennis asked effectively the same question.
Sure. Ralph and Dennis, great question. And I'll make it real simple. The general rules are A, liquidity, B, high IV rank, C, you have to have, you have to be, I guess I'm going to say high implied volatility. I was going to say something else, but let's go with liquidity, high IV rank. Those are the two most important things. And then after that, it has to do a little bit with the implied volatility underlying and the capital it requires to make the trade. So you want to be really careful that on an individual basis, you're not doing things that you shouldn't do capital efficiency wise. Like, for example, if you have a $10,000 account, you cannot sell a strangle and use all $10,000 in an underlying like Zoom. If you have a $10,000 account and you want to sell a strangle in XLE, go right ahead. So it depends on the underlying and it depends on your account size. So I think that that's an important component. The most important thing, though, is to look for the IV rank first and the liquidity second, or the liquidity first and the IV rank second. I don't care what you do. You need both of those on your side. Then you want to make sure that you have, 45 days and you want to have the appropriate capital to make the trade. Other than that, it's just a matter of preference. If you're a little bit bearish, you sell a slightly higher delta call. If you're a little bit bullish, you sell a slightly higher delta put, and the optimal delta, you can start at 20 and you can tweak it from there. Remember what 20 deltas means. 20 deltas means that there's an 80% chance it doesn't get there.
So how long would you hold on to that strangle for? What are your rules for exiting that 45-day 20 delta strangle?
21 days. Or if we make money before that and we want to take profits. There's nothing wrong with taking profits. It's always optimal to take profits earlier than later. So if you want to take profits before that, go right ahead. Listen, if you have a day when you put a strangle on, let's just say you put a strangle on last Friday, and then on Monday the VIX is down 10%. So your strangle comes in $1. You want to take it off? Take it off. We did a strangle last week in Amazon, which I know it's a $3,500 stock, so it's really misleading, but it came in 10 points in one day. We took it off the same day. I mean, just because the VIX came in by $1.70, so Amazon volatility dropped by like 5%. It happens sometimes. You get lucky.
I think that in terms of taking profits, what is the term that we say? There's never a bad idea to take profits. I think is the way that a lot of investors feel in terms of taking profits.
I don't think you can ever go wrong. Right? Exactly. You can. There was an old trader saying on the floor, which is sell half and hope it's the worst trade you ever made. Like, in other words, I hope I just sold those too low, or hope I just bought those too high, whatever, however you want to say it. But, just get out and don't even think twice.
The next question is one that many investors have, is when is TastyWorks coming to Canada?
Yeah, our meeting with the regulators is November 24th. So it's just in about 2 weeks. And then we'll see if we get approved. If we get approved, hopefully shortly thereafter. I don't know if we expect to be approved, but you never know because we're not able to go to make our in-person visit. So we've been trying now for 2 years. The pandemic really effed us up, as you would say. We hope to be there very soon, Tony. I know you have a lot of relationships in Canada. I mean, we have so many. It's our second biggest audience outside the U.S., so we want to get there yesterday. Our meeting is in 2 weeks with the regulators, and that's if they let us do it by Zoom. We assume they're letting us do it by Zoom, and hopefully we'll be approved. And then after that, we can deal with the clearing side and launch, but we'll see.
Great. I know a lot of investors are waiting for that. There were also some questions about, investors that are in other countries. Can investors in other countries open an account with TastyWorks?
Sure. So at TastyWorks, we take people from 65 countries. We're also licensed in Australia. So if you're in Australia, it's a piece of cake. We can't solicit around the world, but we can take, meaning you can come to us. So whatever country you're in, there's a list on our website, and I think it's 65 in total. So we're pretty good in most places. There's some countries that we're not allowed to take people from if they're on a certain list, it's a money laundering list. And if your country's on there, I'm sorry, it's nothing to do with us, but it just is what it is. And so, but we try to be accommodating to everybody if we can.
Great. Here's a question asking, I know we only have about 5 minutes here. Let's try to get to a couple of questions before we wrap up here.
Sure.
The question was around, opening and placing a trade at the market open. The question is, if looking to place an options trade right after the market at 9:30, is there a certain amount of time that we should wait before placing that trade? And it seems like bid-ask spreads are pretty wide at the open. Thoughts around how quickly after the open do you place your options orders?
So you can place your order right after the open, but don't place it before the open. And I'll tell you why. Way too many people place orders before the opening. And so just think about it from our side. Once the market opens, we have a very clear idea of where to route that order based on best price. If you route the order before the market opens, we run the risk of routing it to a place that might not have the best price because we don't know who's going to have the best price until they open. So remember, we don't interact with any order flow. We just send them off to a liquidity provider who sends them off to an exchange. But nobody knows where to send the order before the cash market, before 8:30 Central Time or 9:30 Eastern Time. So what we'd love people to do is just wait till the bell goes off. And as soon as the bell goes off, then you can route whatever you want. And then the order is going to be sent using a BestX order matching machine to the best liquidity provider, who then sends it to the best marketplace. So the best time to send it is, I would wait like a couple of minutes, but that's just me. And use limits. Never, ever, ever use markets.
That's where I actually use a fair amount of market orders from time to time, especially in the very, very liquid names. I only do it in the very, very liquid names where the spreads are fairly tight. I actually find that I'm able to get filled at the midpoint, usually maybe a penny off the midpoint using market orders. But I do generally agree that for most retail investors, it's best practice to stick to limit orders for your trades.
Yeah, a marketable limit order, Tony, is the same thing. And essentially we use marketable limit orders, which just means that you're inside of, where you should be filled, which is exactly what you're saying.
Yeah. So with that, Tom, I do have one last question to ask you. It's a softie, but before I do, I just want to tell everyone, first of all, thank you for taking your time out here today to spend time to go through, the examples. I thought the questions that we were able to get through were fantastic, and I hope some of you that have very similar thoughts as far as, should you sell weekly versus monthly options? Should you sell those really far out the money credit spreads? Why shouldn't we do this? We covered all of those things. I hope that was useful in giving you a better understanding as to how we're thinking and why these mechanical rules we use for our trading are in place. But I do want to share with you an offer that TastyWorks has, which is a free 100 shares on them for opening up a trading account using the link here on your screen, trade.optionsplay.com/Tasty. I'll leave that up on the screen, and Tom, I'll give you 2 seconds to answer this one last question, which is really easy. And the question is from someone asking, how enjoyable is it to work with every day with one of the smartest and funniest traders we know, Tony the Bat?
I've known Tony. So Tony and I have been friends for going on 40 years. It's crazy. I met Tony. We played softball together in the early 80s, and we happened to trade in the same pit. And we've been friends. We've been friends for as long as I've been friends with anybody. And every day he cracks me up still. Every day he's insane. And I think I should be awarded a medal because Tony is a piece of work, man. And he is so funny, and it's hard to focus sometimes. But I figured out his brain. I didn't think I'd be spending 10 straight years with him, 4 hours a day, but we've managed to pull it off. And sometimes we drive each other crazy. But, listen, it's one of the greatest things in life is being able to work with your friends. And I don't know what your situation is, if you get a chance to work with your friends, Tony, or not, but I've had the luck to be working with my friends now for almost 4 decades. And I still have the same group of 20, 30 friends, and we still trade, and we all do the exact same stuff, and it's hysterical, and it's one of the greatest gifts of life. So I never want that to change.
Well, I mean, power to you, and I completely agree. That's one of the reasons why we started OptionsPlay, was because we really felt that we were just having fun. We were building this tool because we were building it for ourselves as traders, and we were able to just have fun doing it, and that's part of why I love what I do. I can say, and I'm one of the few people that genuinely can say I love what I do, and I think you do as well.
I think it comes out very clear in the way you articulate your message, and I think it's great. And so thanks so much for having me today, and I hope everybody got a lot out of this. It was a great talk, and can't wait to do it next time.
Thank you so much, Tom. I hope you guys have a great trading day, and thank you so much for taking the time out here this afternoon to everyone, and we will send out the recording to everyone after we finish here today. So Tom, thank you so much, and everyone Have a great afternoon. And we do actually have Tom booked already for January 12th, same time on January 12th. So looking forward to having you back.
Awesome. Thanks, Tony.
Thanks, Tom. Have a great day.